Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're giving you the conclusion to our 1 year conclusion of comparing all of the Roundhill Investment Weekly Pay ETFs to see who really is the best, who has done the best over the past 12 months, and where everything lies. So we're going to give you our top 10 ETFs from all of our analysis to help you into 2026. Let's take a look at them today. But first, notice to all viewers, past performance does not guarantee future results, and this information provided in this video is for educational and informational purposes only. It should not be considered financial advice. If you need financial advice, always contact a financial advisor or a professional. I am not a professional advisor. When we take a look at the part 5 of our conclusion of we bought all the weekly ETFs from Roundhill, the top 10 ones that come into play is going to be HOW, the Berkshire Hathaway, the NVIDIA, the Palantir, the Google, the AVGW, the Meta, the Goldex, the MagY, and the AMD. When we take a look at the portfolio that we did, remember we invested $1,000 immediately when they came out, and we've tracked everything across the board. Well, PLTW came out to be the #1 fund for yield, almost to that 60% yield barrier. HOOW is running right with PLTW. So if we looked at just yield, we can already see the top 2 funds are these two to look at. Now remember, on the channel, we don't always just chase yield, we look for total return. And we will cover that here very shortly. But when we take a look at the other funds, you can see NVIDIA cracking out at the 40% level, Berkshire Hathaway just a hair under 40, AMD just over 30%, and Meta just under 30. So we see a lot of the funds with some decent across the board yields. When we take a look at net asset value, this is what everyone always worries about. What about the NAV erosion? What about NAV across the board? Well, as you can see, weeklies struggle. The Roundhill weeklies, even them, struggle to try to maintain in down markets. Now, Google, GOW, is up 40% for the year to date. And the gold miners is up over 20%. MagY has kept us above water just a hair, while everyone else is below in the net asset value. So if we're looking at we want to grow our money, well, we want to be in Google or the gold. And we could probably say MagY as well. But everything else, the portfolios have dropped off in the NAV assets. This is why total return is so important. So when we take a look at total returns, it changes the whole structure across the board. Google wasn't even talked about when we talked about yields, but they have over almost a 70% gain because that adds in from the growth of the fund plus the distributions that are applied to it to give you a total, I'm going to call it 65%. HOOW. Now, we talked about HOOW because of yield, but look what they've done also because of total, when we look at total return, they were also down in NAV, but they're right back up here at almost 55%. Now, PLTW, again, was one of those funds that we talked about in yield. Didn't talk much about in growth, but here we are almost at a 50% barrier. One that we did talk about was the GDXW, the miners. Now this one here is just under 30% total return. You can see how we get ranked our top 10 by total return, making GOOW #1 and making AVGW #10. So we put this all on a better spreadsheet. You can see everybody comparing up to date across the board. Now this is broke down by total return on the spreadsheet. We'll start at the bottom, AVGO. We purchased in at 51.82, the current price of 49.01. a 27.89% yield, but it's down 5.42% in NAV. So it's down, so it gives us a total return of 22.47%. This shows you how the distributions and your NAV can work well together. If you have a good, strong enough yield and your distributions, you can afford to have a little bit of a NAV loss to give you a decent return. MagY is another prime example of this one. Has a strong distribution of 23.73% with a loss, and actually they're in a situation where they have a gain of 2.42% of their NAV for a total of 26.15%. But let's take NVIDIA. That's probably the better example I was looking for. And that gives you a 40.64% distribution yield. But with that 12.93% loss in NAV, it still generates a 27.71%. Now, this is where I always tell everybody, don't go out and brag about your 40% that you're getting from NVIDIA in distributions, because you really need to talk about your NAV loss as well. So when you can talk about that, when you can say I'm getting a 27% return on my NVIDIA fund, which is primarily income. The Berkshire Hathaway has done a fairly decent job once they introduced this, a 39.8% total yield and an 11.37 NAV loss for a total of 28.43%. Now remember, these are my portfolios. These numbers will change on a regular consistency as the stock market opens up. These things can change up, down, sideways, every which way. But this is what I did for the past year. It's just been taking every time a new fund comes out, put $1,000 into it, not worrying about the purchasing power, not worrying the price. I just wanted to see what happens. So I'm a better prepared to help you down the road when making these videos, that I could took the hit that you can't afford. I took that hit because we are here to help out. So we take a look at the Meta. Meta's actually done very well, 29.48% yield and only down 0.66% for a 28.82%. Now the gold miners one that I personally like, this one here gives us the best of both worlds. The yield is not as strong. It's 7.12%. Still a very solid number. But they've had a 22.24% growth in NAV. So that's a 29.36% return. AMD, 32% distribution with only being down 0.06%. Again, another chip program that I really appreciate, that the semiconductor package right now, I think, is the top dog in technology. Now we get into the Palantir and the PLTW. Now this has been on my list for a long time, all year long. I've been really watching this fund very heavily. 59% yield I've been able to gain from it with only a 7.32% loss, which gives you that 52.39% total return. Now, HOW was another one, is their number 2 fund. I looked at HOW. I liked it from the beginning. We bought in at the beginning. Has it had some troubles? Yes, it has. Lately, it's been struggling. It's past the quarterly report. Didn't do great for the underlying asset of Robinhood, but overall it's done fairly decent. So we take a look at this one at 59.59% yield, down 3.3% on the growth side of it for a 56.29. And then Roundhill's Google. This one, I'll tell you point blank, this one got underneath my radar. I lost track of it. Should have stayed on top of this one. But look at the yield, 26.58%. But the big talk is that NAV growth of 41.06 because the Google stock underlying has taken off so very well. So let's break down each one of these a little bit closer to you, give you a little more insight, what's going on, where things are coming from, and so on. And Google, you can see, this fund here has a 37.56% year to date at the time of the filming of this video. $68 million in assets, 960,000 shares. So it's not as big as I thought it was originally going to be, but you're giving you that 56.40% total return. And when we take a look at Google versus the Roundhill's ETF, you can see they track each other almost identical. So when Google grows, the fund will grow. When Google drops, the fund will drop. Even with that leverage approach, you can see it's matching almost step by step of the underlying asset. That is what makes a weekly fund do so well, is when it is following its underlying stock almost step by step. You have a good rapport of the two working together. So Google, the overview of it, the strengths is that the balanced income potential. It has that extreme swings like crypto or semiconductors actually have. It's one of the top tech organizations. The key segment, this is what makes Google really cool, is their advertisement. This is their business segments. They have advertisement, they have AI, they have cloud computing, and then they have the YouTube, which of course we love. But then they're into the hardware and they're into emerging businesses. They are not just a search engine that a lot of people think of. They are everywhere and they're continuously working to grow their package. That's why Alphabet and Google together are such a strong piece in this ETF. We'll look at also HOW, the Robinhood Fund. As I said, look at the track history of this one. This one does very, very well with that online technical trading. A lot of retail traders are into this. Why has it struggled? Well, crypto is a major part of Robinhood. And we have seen that with crypto having a basically bad November, and with Robinhood having a bad quarterly review, which came out in November, you've seen a dramatic drop off. But look at the recurrence. Look at what it's done. It can rebalance and recorrect itself fairly quickly. Now we know the thing is a 0.69% total growth. But when we look at that yield at 61.63, giving us a nice total return. Now this one did come out in June 18th, so it does have some more time to mature and develop. When you look at the Robinhood stock versus Roundhill's HOW, this one is a little off for me. It was starting to follow the pattern across the board, but not as aggressively. And over the past 30 days, it's not really following everything to a T of what Robinhood's doing. So this is why we want to always watch the underlying stock. What's the underlying stock doing? What this will do for the fund itself. And you can see it tracks it, but not 100%. So HOW is that Hood weekly pay. It's using that 1.2 leverage. It's a tech-driven volatility compared to the other weekly pays. The income is linked to the cycles affecting by, I hate to say this, but by Bitcoin. Okay, a lot of this comes from what happens with Bitcoin and how Robinhood will come out with new packages to help the retail investor. It's got more stable action than the high growth stocks. So things that will underline the Robinhood side of it is going to be interest rate movements. It's going to be overall stock market demand and trends, and the broader Bitcoin patterns. Now our next one is going to be the Palantir weekly pay. Now this one again, this affects a little bit of Bitcoin. It does have some affections on this. You can see the drop off in November. It has recovered here in December, just not to the levels that it once where it was previously and where it started when we first invested this back in February 19th. But still, $271 million in assets, giving ourselves a very strong total return. And when we look at there again of how the underlying asset performs to the ETF, you can see they are connected, but just not getting the results in the past 30 days of exactly what we're looking for and needing. These are the underlying things that I look at when I start deciding if we're going to make long-term investments into a fund or not. And then our final one we're going to talk about is going to be MagY, the Magnificent Seven technology side of things. This one shows that it's had a great year-to-date run, the growth of 2.11%, a total return of 24.62, primarily that coming from dividend yields. This is one of their older funds, came out April 23rd of 2025, with $218 million on their assets. It just is one of those things, it covers 7 funds, does very good with holding those 7 different funds, of working with those things across the board. It's just, here's what it comes, income generation. It sells those covered call exposures and to collect that premium for that targeted weekly potential income. It's got that mega cap tech exposure to give you that weekly income. Now, the capped upside is the biggest piece of the puzzle. But you can look at the dividends, and the payouts have been very smooth across the board. So in conclusion, here's what I got from all of this. We've taken probably close to 40 different funds from Roundhill. We got them all down to the top 10. And to me, I give you the top 5 funds that I think overall are going to go with me into 2026 and make the difference in my portfolio. The number one fund I'm going to continue to add more money into, and that is going to be Google, GOOW. The next one, I'm going to continue holding my HOOW and take a look at the drip on the downsides, picking up some and adding to my portfolio. Now, PLTW, I will continue to add into this portfolio as well, especially trying to balance out my cost averaging of the pricing that we have. AMDW, I like the chip business. I like that part of it. I think that's the future of our AI package right now. And AMDW definitely going to be one of those stronger funds. And then this new one, I'm going to add to this one. I'm going to keep an eye very closely to it. I will add to this portfolio, and that will be the GDXW, the Gold Miners WeeklyPay ETF. I like the fund because I like the direction that gold's going. I like the direction that everything is looking onto that fund. You have some nice overall growth. I know I'm going to give up a lot of yield, but I'm really looking for growth out of that fund. Those are my top 5 that I'm going to add to it. Am I saying that the other 5 are bad? Most definitely not. But in my portfolio, this is what I'm looking at. Trying to get more yield and protect my downside across the board. Let me know what your thoughts are on this whole package. It took a lot of time to put this video set together to do the review, but I wanted to do this as a year end to give you some ideas going into 2026. Tell me what your thoughts are. Do you like my top 10? Do you like what I'm going to do for 2026 with my top 5? Give me your input. Love to hear back to you. And thank you. Thank you for watching throughout 2025. I appreciate it.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.